Well, good morning, everybody. Good to see you guys again. I'm happy to be joined by a really wise, experienced legacy panel here. So I'm putting a lot of pressure on you guys. You got to step up. But this panel is all about kind of what do we do now? And this seems to be the state of the industry right now, which is what the hell do we do now? So here's the guys and the ladies that are going to tell you how to grow and try to regain profitability in the industry. We had huddled up over the last couple of weeks to prepare questions, so I'm not going to throw it out to anybody. I'm going to throw the questions and whoever wants to answer. But Jade, maybe we could start with you. Just describe who you are and your company. We'll go down the line and then we'll begin.
Sure thing. Can you guys hear me? I don't think this is on.
No.
Still no? Okay. I guess it's just one. My name is Jade Green. I'm president of Next Titan Capital. We do capital raises, mergers, and acquisitions in the cannabis industry. I've been in the business for 10 years, so I've had the pleasure of watching it kind of evolve over the last decade. Definitely need different financial strategies now than you did half a decade to a decade ago. So excited to be up here with these awesome panelists. We're going to tell you guys what to expect for the next couple of years.
Hey there, I'm Scott Moskal. I'm an attorney with Blank Rome. I co-chair with Frank Siegel our cannabis practice. We've been involved representing the industry since 2013, and from Boston, so we're kind of dinosaurs at this point. But you know, it's an interesting industry. It's seen some interesting ups and downs, and go from there.
Thanks, and good morning. My name is Zach George, CEO of SNDL. We are the largest private market distributor of both liquor and cannabis in the Canadian market. We have growing U.S. exposure and a fledgling international export business as well.
Hi, everybody. My name is Ankur Rungta. I'm the co-founder and CEO of C3 Industries. We're a multi-state operator based in Michigan. We're vertically integrated and operating in 7 states today.
Sam Brill, Ascend Wellness Holdings. We're a multi-state operator with 43 stores, including partners, 7 grows in 7 states.
Well, thank you, guys. I think we're just going to pass the mic until we find one that's working. So this is pass the mic hour. So this session is kind of what do we do now that we're kind of past the craziness of the green rush, which kind of hit its high in terms of capital and M&A transactions come in the industry in 2021. So, you know, we did $30 billion in legal sales last year. When I started Viridian, we did $2 billion. So it's not like this is not one of the greatest growth industries in the world. It is. But like all industries, I don't care if it's EV or chemicals or any industry, 7 to 10 years in, you're coming over the top. And it's normally the same dynamics that are driving slower growth. It's overproduction, it's over-licensing, it's too much competition, it's companies competing on price, and it's a race to the bottom. Nothing's unusual about this industry except we're doing it in a federally illegal environment. Just makes it more challenging. So I'm going to throw questions open to the panel. Equity is scarce, to say the least. Debt has filled the gap for the last 3 years. Thank God for that. So what are your companies, and how are you advising your clients? How do you capitalize your business? And if it's equity, what does that look like in terms of structure? Is it common? Is it preferred? Are there warrants? And if it's debt and otherwise. So I'm just going to throw it out there. Maybe Jade, you can go first. How are you advising? You don't want to go first? I'm happy to. All right. You need a microphone? Okay, here you go.
I can yell. I'll yell loud enough. We're sharing. There we go. We'll go back and forth. Well, no, you have a great point, Scott, and I don't think it's a surprise to anyone in this room or at this conference that the equity markets are extremely depressed. It's very, very tough and challenging to raise equity currently. A majority of the capital raises, I think 90% plus in the last 12 months, have been debt. There are pockets of capital out there. We do have high net worth investors, family offices that still see the upside in this industry because we all know that it's there. And it is really about structuring those investments appropriately. Where we see equity still being available are in new markets that have some upside, usually newly legalized markets, usually with limited licenses. None of that should be a surprise to anybody here. But we also have seen that a lot of clients are selling non-core assets to fund the rest of their business. It's a way to not have to raise equity or debt. It's a way to capitalize your business without having to, again, really adjust your capital stack at all. And so that is one way that you can actually get some capital into your company without having to go and do a raise, is just look at some non-core assets, anything that's not accretive to your core business, cut it and sell it, and just be realistic about your pricing expectations, because although there is a lot of M&A still happening, it is mostly distressed assets that are being acquired. So again, if you have some non-core assets that you can sell off, you need to sell those off as quickly as you can. And especially if you're looking for that cash to be able to run the rest of your business, be very, very realistic about your valuation. Be very realistic about what you want a buyer to pay for that asset, because you really need that capital to be able to deploy that into whatever your core business is. On the debt side, again, it is expensive capital due to the federal illegality. We don't have the same access to capital markets and to institutional financing like other industries do. So it is mostly private lenders. A lot of hard money lenders are in the space, but you do have some really good long-term capital partners available. So it's about finding the right lender. That's what we really like to do with our business, is kind of do more of a matchmaking session between borrowers and lenders to make sure that not only are you aligned on structure, on cost, and on the overall direction of the business, but the lender that you bring into your company is your long-term partner for the next 3, 5+ years. And most likely, the path that you set out with that lender, you're going to deviate from that, and lenders expect it. Okay, they've been in the industry for a while. All the capital that's available to the industry is experienced. It's been recycled a bit. It's gotten smarter. And so most lenders know to expect that things aren't going to go exactly as they're planned. So as long as you're honest and proactive with your lenders, if you start facing some economic challenges, you think you might miss payments, you think that you might not be able to service the debt load that you have, don't wait until the last minute. Be proactive, talk to your lenders, and you'd be amazed at how many of them are willing to amend and extend and adjust terms. All they want to do is be repaid. So it may seem like...
For a price.
For a price. There's always a price. But again, a lot of times the debt is still cheaper than equity, especially right now with valuation multiples being so compressed. Raising equity is extremely expensive, so there will be a cost. There will be a cost to amend and to extend. But my biggest thing that I always advise clients is be honest with your lender. They are your long-term partner. And so I think that would be the best advice I could give anybody in the industry looking to raise capital right now.
I think various strategies are being employed. One is, I think, tax mitigation efforts. And as we all know, 280E, is the scourge of the industry, completely unfair for a variety of reasons. But we see clients taking advantage of the 280E letter or legal opinion strategy, in which they are either not paying their 280E component based on certain legal opinions, or paying it all, but then seeking for a refund. I think something new that we are doing a lot of right now are the cannabis ESOPs, in which essentially the company sells itself to its employees. It's a very complex set of transactions, but the sort of highlight is you don't pay any taxes. So you don't pay 280E, you don't deal with that, you don't pay regular 21%. And we're starting to see a lot of our clients really investigate this and some alternative structures within the ESOPs as a means to generate more cash to put back into the business, whether it's acquisitions, paying down debt, et cetera, et cetera.
Yeah, ESOPs are a great opportunity. I would just make 2 points just to add on to Jade and Scott's comments. We've seen companies be able to actually pay their 280 obligations at the margin in the sector. We've seen companies generate free cash even though they have expensive sale leasebacks. We've seen companies be successful despite relatively large debt balances. If you have all three in play, it's likely a recipe for real problems. I would focus on unlocking capital through strength in operations, and the biggest call out would just be to be able to model your own business to weather a cycle. So whether that's the dynamic that's occurring in Florida or here in Illinois, these markets are going to continue to change. So if you think that it's your sort of God-given right to earn very high gross margins at retail, you need to make sure you're testing those assumptions and understanding what the performance is going to be with more competition and price compression, which is all going to benefit the consumer. It's all going to mean more THC over the long term that's being consumed. But there are businesses that will not survive those dynamics, and so it's important that you understand what preparations need to be made.
Yeah, I think all of what these panelists are saying is right. I mean, the way I look at it, I think it's a very tough time to do any deals right now. And the reason I say that is institutional equity is basically non-existent. There may be some pockets here and there, but it's basically not able to be found. Debt is also very expensive, and I think a lot of the assets that we're looking at, if they're attractive right now or they're at what we call peak performance, we're always worried, are these assets going to decline over time? A lot of these markets are really flat. There's more competition coming into them. So if you're going to take on incremental leverage to buy an asset that may have declining performance over time, you can end up in a really tough situation on the other side of that. And so for us right now, it's using the cash flow that we generate to finance new M&A, being extremely cautious about what we buy and what price we buy it at. I definitely think financial engineering is a key part of the equation right now. So can you get sellers to take seller financing? Can you structure earnouts in the transactions? You know, if the most successful publics are trading at 4 times, then what can we really pay for an asset, right? I would argue you have to pay something less than that. And so are there sellers that want to sell at that price? Again, if they're at peak performance, are their expectations in line with what that asset might look like in a couple of years? And so I think for me, it's a very challenging time. I think we're trying to be very selective about what we look at and what we entertain, and really, buying expensive assets in this market that are high performance I find it really challenging.
Yeah, if you're trying to put together a structure for something new where you're purchasing an asset, you better make sure you're underwriting it properly and looking forward, not backward. And like Ankur said, you're seeing a lot of companies that have kind of hit their peak performance and they're on the other side. So taking on debt or other structures in order to finance that, it could be tricky, and you just got to make sure that you're underwriting properly. That's the way we look at everything. We look at everything towards the future on a forward basis. We try to buy assets that only fit our footprint and our basically we call it densification, where we're really just getting more stores really in a market. So we control that vertical sale better, and this way we can control our outcomes more so than an independent. But if you're an independent looking to finance that structure, you really need to underwrite that in the right way and be careful about who you take money from.
Yeah, if I could just add to that, I think we're very much in the same place of, we don't use the term densification, but I like that. I mean, to go into a new market right now, especially through M&A, I think can be very risky. And so adding to your existing portfolio in states in a way, if you're vertical, that adds to your portfolio or that just strengthens your position in that market, I think makes a lot of sense. But to go and buy a new asset or a new portfolio, a new platform in a new market, I think can be very risky. And certainly for us being in 7 states, we feel like we're spread too thin in some ways. And so creating the scale in each market, which I think allows you to have more market power as those markets inevitably become more competitive and in some cases decline.
So Sam, you completed within the last month a $50 million debt raise. We wrote about, let's give that a hand. We wrote about that in the Verding Cannabis Deal Tracker. So as briefly as you can, because we're going to get tugged off here soon, how complex was that process and the transaction? And what is your primary use of proceeds with that capital?
So that was specifically to refinance a $60 million term loan that we had coming due in August. It was also part of a financing that we completed last year. That financing was very complex. Refinancing a $250 million in debt in this environment is tough, especially actually a year ago, I think it was even tougher. And we had good lenders who want to be actual partners with the company. So we were very fortunate in those conversations, and they agreed to allow us to leave the $60 million outstanding because there was a prepay penalty on it, and the interest rate was lower. So we got to save millions of dollars by being able to delay that and do it now. But putting this behind us, now we don't have any maturities until July of 2029.
Many people think that it's a buy-side environment right now, and it is. But unless you're a loan-to-own lender, you don't want to be running the company. So there is some flexibility, right, in trying to get terms and the amend and extend. Did you find that the process with your lender on the refi?
No, I mean, our business is, if you look at our leverage ratio, it's less than 2 times. So it's not like you're looking at a situation that, you know, you have this tremendous deterioration. We're within our core markets, we continue to gain share. And so I think the lenders realize that, and you know, it was, look, at the end of the day, they're underwriting it, and it's costing me another 325 basis points a year in interest. So it's not like I didn't pay for it.
So, Zach, I interviewed you a year or two ago, I think, at Benzinga. And when I was looking at your public filings for that year, I don't know if it was a majority or a close to majority of your income and revenues were coming from you acting as a bank, as a lender to primarily Canadian companies. How did you evolve to that practice? It seems to be working for you. And 2 years later, what does that look like now for you?
Yeah, thanks for the question. So we restructured our business long before many of the other debt issues have come to the forefront in the marketplace. So our restructuring occurred in 2020, and thereafter we built out a 2-pillared model, one based on building a strong vertical enterprise in Canada, where we are just about to cross 200 retail doors and have manufacturing capabilities in every relevant product segment. And then also we're looking at what was happening in the space generally, and saw that the economics being earned by parties providing financing in the form of high-cost secured debt, ratchet convertible notes, and unit warrant deals were far more attractive than the economics being earned by the companies. And so we did have ambitions to grow, and we were suffering from a very high excise, fragmented market where we were subscale in Canada. So at that time, building out a credit portfolio that would generate cash-rich interest income was very attractive as we were looking to get free cash flow positive. We've now gained scale through that process, but in a sense, the credit portfolios that we've built out on both sides of the border turned into a bit of an M&A pipeline where we've taken 4 different companies through CCAA in Canada. As a result, we're now, for example, the largest producer of edibles in the Canadian market, and represent some strong U.S. brands there. And we're just trying to complete 2 reorganizations, one in the form of a foreclosure, one in the form of a receivership in the United States. And our board is exploring whether or not we should maintain our current NASDAQ listing or adopt a posture that is seen with most of the major MSOs, with a combination of OTC and then CSE or TSX listing.
Because of the cost of filing fees and being on that exchange, or why would you move to OTC?
It is expensive, but as I think you're aware, if you have a NASDAQ listing, because NASDAQ avails itself of federal financial infrastructure in the United States, you can't, strictly speaking, engage in plant-touching activities. So if we want to operate businesses in the cannabis space in the U.S., it would be highly inconsistent with our NASDAQ exposure as it sits today.
Interesting. Yeah, it was interesting to see some years ago there were no publicly traded NASDAQ-listed U.S. cannabis companies. That's verboten. But the Canadians came down, Tilray and you and others. So as I said in my earlier speech, I just find it so sad and frustrating that a global industry with this level of consumer base and knowledge and hundreds of years of consumption, at least in the U.S., is riding on the back of federal regulatory reform. And can anybody in this room tell me when that's happening? Yeah, so that sucks, but here we are. Just before we get back to Jade and Scott, for the 3 operators, you know, I've worked in other industries, and it seems when growth slows organically, you acquire growth, you acquire profits, you acquire IP, you acquire people, you acquire brands. So for the 3 operators, what are you looking at? And are you looking at distressed assets? Does it have to be accretive? Does it have to be within the states you're operating in so you maintain focus? What is your M&A strategy?
For us, it's the densification. So we're really primarily looking at states that we're already in. like I said, we're going to have the highest batting average for assets in those states. We're one of the largest wholesalers, so we know who's buying and at what volumes. We can see the rate of change. So we already have sort of inside baseball into how an operator's doing. And so that's the easy one. It's not to say that we won't look in other places, but I think I share Ankur's view that it's hard to, each state is like its own country. It's a different set of regulatory rules, and you can't cross state lines, so you really have to get more vertical, more density in order to be successful. And that seems to be the only areas in which, like when I look at my business, I look at my 7 states, the states where we are deeper are the ones that are most profitable. And that's where I want to build on that.
What's the reason for that?
It's because it's the vertical nature of it. So
Operating leverage.
Exactly, the operating leverage. And you don't have a lot of operating leverage if you only have like 3 stores in a grow, because it's a large market and it's hard to do that.
Yeah, no, I think it's the scale and the verticality that give you the operating leverage and the higher margins. But just to address one of your early comments, I do think we're getting to a more mature point in the industry. So the fact that growth would be slowing, I don't think is that surprising. But I would say that it's slowing more than it otherwise should because of things like intoxicating hemp and other issues that we're dealing with. I think most of us, as you look at like new rec markets that have launched in the last 18 months, they are really struggling. They're not performing at the way that people had expected. If you look at per capita spend, which is a metric that we look at a lot, that's much lower in these new markets than was expected, and it's certainly much lower than some of the more mature markets. And so I think you have to ask yourself, why are the overall markets not performing exactly the way that we had all projected? And I think that has a lot to do with these outside headwinds that we're facing. So I do think that that's been a bit of an unexpected surprise relative to where you might have expected the industry to perform at this point. In terms of what we're chasing, yeah, I think it is about densification. I think it is about growing, our businesses in each of the markets that we're in. I think we'll look at stuff in a new state. We've looked at some stuff with you guys recently. If we feel like it's a standalone platform that's got the scale already, if we think it's a somewhat stable marketplace where there's not going to be a huge amount of volatility going forward, in the supply chain, in the supply-demand dynamics, then we'll start to look at it. Financeability, of course, like we talked about earlier, like there's some attractive assets out there, but if they require a ton of cash, a ton of equity, that's going to make it really tough to do no matter how attractive it is. So certainly thinking about, is there real estate in the deal? Can you finance off of that? There's lots of creative ways to try to approach it, but I think the bar to invest into a new market is much higher now than it was before. And for us, I think we're okay buying stuff in existing states. Like Sam said, we have a good understanding of those markets and the dynamics. If we're going to enter a new market, I'd much rather do it organically. And so, for example, we're entering Kentucky. We applied there. We were able to win licenses, and so I think that's an attractive way to enter a market sometimes, and I think in this environment can be a much better way to enter a new market than trying to buy your way in.
So you mentioned intoxicating hemp, which I remember the passage of the Farm Bill in December of 18. I'm sure a lot of you guys do as well. And by the first half of 19, Pepsi was coming out with a hemp-derived product, Coca-Cola, Coors, Molson, and then the FDA started sending out warning letters. This is not a food ingredient. And by the way, this company, GW Pharma, has some IP on hemp. And by the end of February 19, a lot of those companies went out of business. Last year, I think the hemp-derived infused products category, obviously beverages at the top, but others, was a $1.5 billion market from nothing a few years ago. And it's got some existential risk to it, obviously.
I think the market is much larger than that.
Okay. So where does it go? And I know it's impacting the traditional cannabis industry, but what's your thought on the hemp-derived space when you get a legal opinion, when you get an investment banking opinion? Where does this go with all of Total Wine and Spirits and Southern Glazers and the biggest liquor distributors in the country? Literally, the 2 largest are now distributing hemp-derived infused beverages into liquor stores. Where does this go? And are you going to go Curaleaf, Trueleaf, GTI way of stepping into the game, or are you going to stay out of it, opening it up? Actually, you guys have spoken the last 10 minutes. Scott and Jade, you go.
It's all part of this one. I can't speak from an operator perspective, and I've stopped trying to predict the future on what's going to happen from a regulatory perspective, but I can tell you from an investor perspective, it is really tough to invest in an industry, describing intoxicating hemp, where there clearly are a lot of companies making some very high returns, but the defensibility of it and the longevity of that industry, I think, remains to be seen. So I think that you'll see like some hard money lenders getting in. I think you'll see some lenders looking for those 15, 18% returns, but not expecting there to be a long-term opportunity. I think raising equity in the intoxicating hemp space, again, you'll find pockets of investors who are willing to take that risk, and you're going to pay handsomely for it. But I think until we see either a convergence of regulations, for all cannabinoids, or very, very clear delineation, you're not going to see a ton of investor capital rushing into that space. And I think it is, to Ankur and other people up here's point, it is taking such a large amount of market share from the regulated cannabis industry that it's also making it more challenging to raise on the regulated side and on the licensed THC side, because we are losing market share and numbers look worse. And, we see what happened with Ohio, exactly that same trend. I mean, the numbers just didn't take off after rec sales began like everybody had anticipated. And it's because there is a lot of market share that's coming direct to consumer, intoxicating hemp. There clearly is a business there. There's a consumer demand. People are buying those products. But again, the defensibility and the longevity, I think, remains to be seen. So I don't see, billions of investor capital going into hemp over cannabis. I think overall investors are just waiting to see what happens and being patient. Or they're getting in now and charging a lot for it.
I agree entirely. I think also in terms of raising debts, we represent a lot of lenders in the space, and they'll come to us. And I mean, how do you underwrite an industry that is facing constant regulatory reform, almost like on a daily basis from state to state? Texas has a bill now that's before the governor to ban THC infused from hemp beverages. But there's 7,700 or more stores in Texas selling intoxicating hemp products. How do you underwrite that? Additionally, there's no standards in the industry as you find like in cannabis. So can you have pesticides in your, can you, what is your processes? Is Delta 8 as safe as Delta 9? And you're starting to see some class actions go out there or product liability suits. And how do you defend, or how do you underwrite that? And I think, yes, there's a lot out there there are a lot of groups out there who are definitely digging into the traditional THC market. But as more and more states try to regulate it in the same vein as they have sort of cannabis or marijuana, I think that will create, hopefully, an even playing field. Because even from some of the intoxicating hemp companies that we work with, the ones, there are those who already institute all those standards as if hemp were a legacy THC product. And I think those are the ones who probably are paying more now, make sure everything's lab tested, et cetera, but potentially could be accretive to the industry as a whole at some point.
Go ahead, operators. I'd like to get your perspective.
Yeah, for now, these issues are getting kicked to the state level, Farm Bill review notwithstanding. There is a chance here that this kind of quagmire mess, however you want to characterize it, is actually going to be net beneficial to the regulated cannabis industry. There is destigmatization that's happening through the proliferation in the hemp beverage space. I personally don't believe we're going to see a scenario where you have 600 plus different beverage brands that survive over the long term. But the short cycle economics are phenomenal, right? So we need to see a lot more change. We can debate elements of sort of how libertarian of a view you want to have in terms of adults making consumption decisions and taking risks on their own. I think the one sort of bright line for me is just making sure that we protect minors when it comes to all intoxicating products. And I'm not sure why that would be up for debate.
Ankur?
Yeah, I guess I would say I'm generally pretty bearish that this genie's going to get stuffed back into the bottle. To me, there's probably some really strong legal arguments and maybe moral or ethical arguments about how we want to approach intoxicating substances, but I think the reality is this is a massive industry. I think it's $30 billion plus is my take on it. I don't think we have great data on, who's selling THC flower and what gas station or whatever, but I think that it's probably not going to go away. So from my standpoint, I think all of us on the licensed THC side, we need to underwrite and do our forward planning, assuming that it's going to be there. And if it does go away, then maybe that's a win for us. But I'm just seeing kind of how it's playing out in terms of federal lobbying. I'm seeing a lot of state efforts failing right now. It'll be very interesting to see if this Texas bill goes through or not. I think that'll be kind of bellwether for the country. But it does feel like there's a lot of commerce being done, and so as a result, there's a lot of reluctant politicians that don't want to shut it down. And so I think we just all need to plan accordingly, and whether that means for some of us entering the space or just underwriting our markets in a different way. I think it's here to stay, and it's having a huge impact on the industry. And certainly, as I said, as we look at new markets that are rolling out, we are having a much lower set of expectations about how those markets are going to perform over time than we may have when a new rec market opened a few years ago before all these products were out there.
Yeah, look, I don't think there was an intent in the 2018 Farm Bill to legalize intoxicating hemp, but they did it by mistake. A significant industry was born. I believe the numbers I saw for Texas alone is 5 to 8 billion. So it's a very big market. It's very hard to take a market like that and stick the genie back in the bottle. It does need to be regulated. I don't know why there's any debate about that. People need to know what they're putting into their bodies. You need age gating. Right now, in most states, you can go into any gas station and kids can purchase intoxicating hemp, all different form factors, with no ID and a credit card. So, that definitely needs to be addressed, whether it's on the federal or state levels. And as an operator, we're seeing it. Ohio was mentioned. I mean, that is one of the most pervasive markets where literally every gas station is a dispensary. And that's one of the reasons I think that the state's been muted to some extent. And it's not Ohio. Ohio's not that. Florida is probably just as bad, if not worse.
Even markets like Connecticut, where we just started, I think it's a huge
everywhere.
impact on them.
And so we have to operate as if it's not going to go away. I do think that there is an element, especially in beverage, where there's an opportunity for people who have been shy to go to a dispensary. It does take down that barrier. And there is some data that's come out recently that people who buy intoxicating hemp for a third time that had never been to a dispensary generally visit a dispensary for the first time. So it's like you do it three times.
Sam, where did you see that?
I saw it from Ian Dominguez at CanadaDataCon. So it was an interesting statistic. I don't know where he got it from. But it was encouraging. I mean, I think there's a stigma for some people that it's weed and it's bad for you depending on when you were born, and this does take that stigma away. And once you've had it a few times and you're comfortable with it, people get more curious and they want to go to the next step and they come to the dispensary. So I see that as a potential value add in the long term.
Wow, that's cool. I never heard that. All right, we'll take it. Anything that drives consumption, we'll take it.
And I'll just throw something else out there, Scott. I mean, people are probably hearing about this, but like in Missouri, for example, there are efforts, I think, for the licensed THC industry to work with the alcohol industry to sort of create some kind of a compromise approach to this stuff that could be win-win for everybody. And to me, what that looks like is allow low-dose hemp beverages to be sold through the alcohol three-tier system. But I think for us, the key thing in that exchange is we need to protect our basic form factor. So flower, vape carts, edibles. In our view, those things need to be sold through the licensed THC channel, even if you allow for some form factors or low-dose options in other channels. I think that's kind of, in my view, the emerging compromise that we'll have to all keep an eye on. There was an attempt in Missouri to pass a bill like that. It ultimately failed. And so we'll see if that becomes a viable option in some of these states.
Well, Texas is going to be the bellwether, as you say, but it's not the governor's decision. It's Dan Patrick, the lieutenant governor, who we financed the first licensed operator in Texas. We did a few rounds with them. And Dan Patrick is as anti-cannabis.
Yeah, but the governor has to decide whether he's going to sign the bill or let it through now.
Yeah, but practically, legislatively, that's true. I don't think it's his decision ultimately. But
well, if that's the case, then it's going to go into effect. So.
Okay. Go ahead, Zach.
If that's true, isn't that you making a call on the outcome right now?
Sorry?
Aren't you making a call on the outcome right now if that's the case?
My bet is it's going to get shut down. It's going to get shut down. All right, guys, I've got more questions. This is an incredible panel. I wish we had more time, but I want to thank Benzinga, and I want to thank our panelists. Thank you.